He grew up just across the river, right in Gloucester City, New Jersey. He obtained all his degrees in higher education at the University of Pennsylvania, a BA, a bachelor's degree, two master's degree, a PhD. Yeah, he had some time outside of the area. Right? We have Washington and California, but like a magnet, right? The area brought him back every single time. And he's here with us. And as a fun fact, right? He told me that, well, he is a die-hard Eagles fan. And he had this game, maybe we could say a competition with the president of the Federal Reserve Bank of Boston, in that if the Eagles won, they would have to give their employees cheesesteaks, right? And if the Patriots won, they here at Philadelphia would have to give everybody a clam chowder. Yeah. So well, you know the rest of the story. If I wanted to mention everything that Dr. Harker has done in his career, I would spend more time than he would. That would defeat the purpose, obviously. So just let me mention just a few of them in no particular order. Dean of the Wharton School, President of the University of Delaware, Consultant Engineer, Fellow at the White House, a Special Assistant to the Director of the FBI, Professor of Management and Private Enterprise at Wharton, Professor and Chair of the System Engineering Department at Penn, and I have to switch my paper here, Chair of the Wharton Operations and Information Management Department, youngest faculty member in Wharton's history to be given an endowed professorship, Editor-in-Chief of Operations Research, a top journal in his field, several institution boards, more than 100 publications, and last but certainly not least, President and CEO of the Federal Reserve Bank of Philadelphia. Talking about the Fed, for many of us, we think of the Fed as the central bank of the nation, right? So in other words, it's these guys that print money, right? And then they're very obsessed with inflation, all right? In other words, right, it's that's the Fed. But for some of us, we also know that they have some other objectives, like trying to maintain the unemployment rate low, like near what the full employment should be, and they also oversee the financial system. However, if you dig a little bit more in terms of the strategic objectives of the Fed, there's one that's quite unknown, and which is, and I have to read it here, is to administer consumer financial protection laws, including those laws that would encourage financial institutions to meet the credit needs of local communities. And it seems that it is in this area that Dr. Harker has found his latest passion, right, which is student loans in the time of rapidly rising college tuition rates and the impact of on both access to higher education, in particular for groups in society that have been traditionally underrepresented, and also on the impact of the economy. So we're eager to hear you, Dr. Harker, and the floor is all yours, and welcome to St. Joe's.
All right, thank you.
No problem.
All right, well, good morning. Does this work? Yep, all righty, thank you. Well, thank you for that introduction, and it's great to be here after many years on Hawk Hill. The hawk will never die. And actually, we have some of our employees, many of our employees went to St. Joe's, so I have to say that or I can't go back to work this afternoon. So today I'd like to discuss every college senior's favorite subject, as you heard, student loans. Not just as they pertain to the individual, but the impact they and other facets of the education landscape have on the U.S. economy overall, and why this subject is one every American should worry about, every American should consider. But before I get to that, I want to take care of two housekeeping items. The first is an introduction to Fed protocol, and that is the issuance of a standard Fed disclaimer. The views I express today are mine alone and do not reflect anyone else in the Federal Reserve System or on the Federal Open Market Committee. There, you all are my witnesses. I can't get in trouble now, okay? The second is, I promise to be short, but I want to make sure that we talk a little bit about the Fed itself, okay? The Federal Reserve, you heard a little bit about from Christian what we are. But I want to talk a little bit as a second housekeeping item, just to set the groundwork of what the Fed is. The Federal Reserve is the central bank of the country, but it stands out among the world's central banks for a very unusual structure, a decentralized structure. Now, how do you decentralize a central bank? You establish 12 regional banks across the country that are independent of, but work alongside the Board of Governors in Washington, D.C. That structure was established over 100 years ago to ensure that the realities on the ground in this vast and varied economy would be recognized when national policy is made. That is, national policy is not being made in the bubble of the Beltway of Washington, D.C. alone, that the regional banks are important voices. I think that was a prescient decision. As the landscape of this country has become even more diverse and eclectic in the intervening century. Now, for example, the concerns of the residents here in the Philadelphia Fed's district are often different than, say, the Dallas Fed. So when all of us meet to decide policy, which we do about every 6 weeks, we get together, each of us walks into that discussion with a unique perspective. We are the voices of our region. Now, while the Fed was created by and is answerable to Congress, it is an independent entity which shields it from political pressure. This is a crucial element to safeguarding the country's economy. You obviously don't want people making cosmetic decisions in the short term for the sake of political expediency. You want people who are looking at the medium and long-term implications of their actions and making decisions based on data. You want policy wonks, and we are an institution full of policy wonks. You may not want to hang out with us at a party, trust me, but you're probably pretty happy with us relentlessly analyzing data on your behalf. Now, the Fed has a host of responsibilities. You heard from Christian some of those, from providing currency to banks to undertaking research to working with local communities to encourage economic growth, mobility, and stability. But the most well-known and primary function of the Fed is conducting monetary policy in pursuit of our dual mandate, which is price stability and maximum employment, or in other words, inflation and jobs. We want inflation to be slow and steady. Our current target rate is 2%, to keep pace with growth without devaluing the money in your pocket or in your bank account. Now, by maximum employment, we mean, in an overly simplified nutshell, that if you're looking for a job, you can find one. You can find one relatively easy. We make no guarantee that it will be your dream job, but in a strong labor market, a paycheck should not be that hard to come by. Because people move in and out of the workforce all the time, unemployment will never be zero. Now, for example, when you graduate and start looking for jobs, you're considered unemployed from the time you start looking until the time you find one. A certain level of churn in the labor force is actually healthy. As for what's ideal, there is sort of a magic number for unemployment called the natural rate. Now, that changes depending on the makeup of the economy, and we never really know exactly what that number is until it's in the rearview mirror. Though we do have some estimates. The current unemployment rate at 4.1%, for example, is at or below the natural rate in my view. Now, there are a host of other factors we look at, including labor force participation rate, how frequently people quit jobs, because generally people won't quit a job unless they can get another job, how long jobs stay open, and just how many net new jobs are created, just to name a few of the many variables we look at. So, what does this all have to do with student loans? A fairly tight labor market means jobs are relatively abundant, which in turn means fewer excess workers. That is great if you're looking for a job, but less so if you're a business that wants to expand. Additionally, if most of the potential workforce is already off the sidelines, it means the labor force itself is unlikely to grow significantly. One of the more straightforward rules of the dismal science is that economic growth is basically, it's a simple equation. Economic growth is fundamentally growth in the labor force plus growth in productivity. Productivity growth is currently quite low, not just here in the US, but across the globe. So if the labor market can't keep pace, the economy will suffer. Ultimately, the strength of our workforce and its trajectory depends on a couple of factors, and one of those is how and how well it's educated. So I want to talk today about the ways the education system, particularly post-secondary education, affect the U.S. labor market. Like all things, the current state of the American workforce has to be taken in context. And there are some important facets to consider in today's market. First is the effect of technological advancement on the landscape. To be sure, this has been a factor since humanity first set out a rudimentary economy based on barter and trade millennia ago. The transition from the Stone Age to the Bronze Age to the Iron Age reflects an evolution of the technology of those times. Fast forwarding to more recent events, the introduction of the steam engine, the assembly line, the refrigerated transport system were all their own game-changing technologies that fundamentally altered the world's business and economic composition. But whereas we once saw those technologies advance at centuries or decades pace, we are now in the throes of advancement that appears to upend industries on an almost constant basis. In that sense, there's more change within jobs and industries and more need for continual retraining and upskilling. As the labor market has steadily improved, one of the problems that's arisen is a mismatch of skills. That creates an issue when employers want to expand their businesses, but they can't fill the jobs they already have. And the faster an industry changes, the more that can affect the skills gap. Auto mechanics, for instance, now need a level of computer knowledge that's a world away from what would have been required, say, 20 or even 10 years ago. Think about how much of a car, how much of just the dashboard is digitized, and compare that with a car that was manufactured in the 1990s. Now, or have one of your professors describe it. Ask them to tell you, for example, about something called a CD player. As the labor market continues to get tighter and tighter, workers with specific skills will likely be harder and harder to find. And if businesses can't fill the jobs they have now, they are not going to be able to expand. The second dynamic is demographics, which again has been a factor throughout history, but is different now than at any point before. As a parent of 3 millennial children, I am acutely aware that the younger generation feels unfairly maligned. But for this particular phenomenon, one that will put distinct pressure on the economy and the workforce, you can firmly blame us, the olds. The baby boomers will be the largest generation to date to head into retirement. They're also living longer, which as a boomer myself, I think is a really, really good idea. I am very much in favor of it, but it does mean an unprecedented number of people living out their post-working lives for longer than we're used to. That means more, for example, more people benefiting from Medicare, more people drawing Social Security, and more people needing assistance with everything from day-to-day care to transportation. Those programs are funded in large part, by the American workforce. And that assistance will require more workers at a time when there are fewer and fewer left to come off the sidelines, and in fields that require special education and skills. And then finally, there's the price of education. I know you know about that. I'm sure you've heard it from time to time that things are now much easier than they were in our day. That, you're living in the good times. We had to pore through textbooks while you have Wikipedia. We took pictures with film, and we couldn't make them look any better afterwards. We were what we were back then. We walked into school in knee-deep snow, up Hawk Hill both ways. That's not true, but on this count, so the times are decidedly working against you. They're not always better. Millennials are much more likely than older generations to have taken out a student loan. And both the sticker price of tuition and the discounted rate have risen faster than incomes over the past 20 years. At the same time, state funding for higher education has been steadily diminishing. That is both a factor in the rise of tuition, though certainly not the entire cause, and will likely to continue to get worse as those demographic trends I mentioned continue to play out. local, state, and federal budgets will be even more pressed as funds increasingly go toward retirement benefits, pensions, and health care. As tuitions have risen, and more people, have started going to college, both the share of students who take out loans and the average amount of debt borrowed has grown substantially. It is now a larger portion of consumer debt than auto loans or credit cards. In fact, it's second only to mortgages. Now, that reality doesn't just affect you, the people holding the debt, though it's obviously a significant issue for you. It affects the wider economy in a variety of ways. First, the burden is starting to spread across generations within families. Second, it affects people's life decisions after school. And third, it can exacerbate income disparity. All of these play a role in the country's economic future. Let's take these in turn. First, the multi-generational effects. Research shows that in the decades leading up to 2015, the number of adults over the age of 60 who took on student debt fully quadrupled. Roughly 3/4 of those people assumed that debt on behalf of children or grandchildren. That means a substantial portion, and a significant number of people, are holding debt who are either living on or heading toward fixed incomes in their retirement. Now, since those golden years are likely to last longer than their parents did, they're also more likely to encounter increased care costs, which creates even more pressure. Not only is this a financial issue for families to contend with, it increases the likelihood of default. Second, the looming specter of debt appears to be affecting areas of the economy that are fundamental to growth. Research by the Philadelphia Fed's Consumer Finance Institute, as well as some others in the Federal Reserve System, show that student debt is affecting both small business formation and home ownership rates. Now, there's a narrative out there that millennials don't want to buy houses. But there's another plausible scenario, which is they don't feel like they can afford to buy it. That's not an option. Carrying a student loan burden in itself can both affect early career choices and dissuade people from making another investment. But it also affects the ability to do so. Buying a house means having a down payment, and that's difficult to accumulate if you're paying off loans. It also means getting a mortgage, which requires good credit, and that credit is affected by the debt you carry. The ratio of your outstanding loans to your current income is one of the major factors lenders look at. And meeting an acceptable bar can be especially difficult for people in their first few jobs out of college, when salaries aren't as high as later in your career. It can also prove difficult for people in careers that pay less overall, but are incredibly valuable to our society, like teaching or social work. Student debt is also a different animal than, say, auto loans or mortgages, because it's non-dischargeable. That is, even if you file personal bankruptcy, you can't get rid of it. This is rooted in a concern that people will look to unfairly dismiss their debt even if they have sufficient incomes. I should note that research by our staff in Philadelphia and others does not find evidence to support that theory. All in all, research by the Fed's Board of Governors finds that in the first 5 years after school, a person's chance of owning a home drops by 1 to 2 percentage points for every 10% in student debt a person holds. Ultimately, if the ability of our younger generations to participate in the economy is adversely affected, so overall is our economy. Finally, I think there's a really important issue, the issue of parity and access to higher education. This question of access is important because data show that the investment is absolutely worth it. Research from a number of sources, including our colleagues at the San Francisco and New York Feds, shows that overall, the investment in college still delivers a very good return. We have a visiting scholar at the Philadelphia Fed whose research delves even deeper, showing life cycle returns on varying degree majors. Business and STEM pay off the most in terms of financial return, followed by social sciences and then arts and humanities. His name is Doug Weber, and he's a professor at Temple. And he's actually has a list of expected lifetime earnings broken down by major, if you want to see what's in store. You may not want to share that with your parents, that's up to you. The one caveat from all the research is that to reap the rewards of college, you have to finish college. The returns to attending but not graduating are not very significant. And those who don't finish struggle more, and actually more and more, with their debt burden. I should say here that I've been speaking about post-secondary education in the broadest sense, and the issues associated with loans, particularly that taking on debt and not finish a course of study can have adverse financial effects, applies to all its forms. I firmly believe, though, that not everyone wants or needs a traditional bachelor's degree. And the Philadelphia Fed has done extensive work on alternative pathways, from apprenticeships to skills training, to bring people into the middle class. There are a host of jobs that my staff has deemed opportunity occupations, which pay at or above median income, but don't require a 4-year bachelor's degree. Practical training and skills development in both conventional and non-conventional sectors fill much needed gaps for employers and offer careers for people who prefer that route. But the constant across all these options is that education and training, whatever form it comes in, are absolutely necessary. Apprenticeships and other learn and earn programs are excellent models that can also ease the financial burden on the student. But for those who do want a 4-year degree, and for anyone who takes out a loan for any type of education, I want their opportunities and access to be the same as their wealthier peers. I am concerned that the looming shadow of student debt, coupled with increasing uncertainty about loan forgiveness programs and income-driven repayment, may dissuade some potential students, particularly those from low and middle-income families, from going to college or pursuing jobs in, say, public service. I'm additionally concerned that the school's budgetary constraints may contribute to fewer of those students succeeding if they do attend. You know, the financial considerations for families are fundamental, but there are other, less tangible factors that either erect barriers to entering a college or affect student success once they've enrolled. As you know, there are more elements to the school experience than just tuition and books, and campuses around the country have done great work to address that fact. Whether it's navigating office hours or finding resources like free tutoring, programs that focus on underserved students have been, I believe, a very important factor in their success. And there's a good body of research to back that up, both qualitative and quantitative. In fact, one of the Philadelphia Fed's research teams is currently working with Rutgers University Camden to assess the outcomes in one of its financial aid programs. And in this case, one that offers financial relief to students well into the middle class cohort. Part of their goal is to clarify those additional support needs. Now, when I was president at the University of Delaware, we had a program for students who were the first in their families to attend college. We had them arrive in June so they could spend a few months familiarizing themselves with experiences their families just couldn't give them firsthand advice on because they had never gone to college. Some of it was academic, but a lot of it was soft skills, and it worked. Those students had first-year GPAs equivalent to their classmates whose families had a history of college attendance. But I worry about increased cost pressures on institutions may force them to cut or curtail those programs, which I believe would be a great loss and disproportionately affect lower and middle-income students. While on the one hand, this is a simple matter of fairness, and the crux of the argument is that a level playing field will ensure the success of the best, not the best funded. It is also a matter of importance to the economy. We're talking about our future workforce, and to misallocate those resources or funnel exceptional minds away from areas where they could have the most impact is shooting ourselves in the foot. Financial uncertainty and cuts to programs that support underrepresented students could exacerbate the achievement gap and increase social inequality and income inequality. This is not just a social issue. Research shows that inequality exacts a financial cost to a country as a whole. We're also missing out on vast opportunities on a national scale if we are not tapping into our resources, all of our resources. A recent study investigates what the authors call our lost Einsteins. The researchers looked into the backgrounds of, for example, patent holders in the United States and found some common themes. People who scored well on math tests in elementary school made up the majority of patent holders, which was not a surprise. But they also came overwhelmingly from privileged backgrounds. Low-income students who scored the highest on the test were not any more likely to hold a patent than wealthy kids with below-average math scores. There were similar results for women, minorities, and people who live in the southeast portion of the country. Since women alone make up more than half the population of our country, the simple math tells us we're missing out on a lot of potential and productivity in a majority of our population. The bottom line is that education is a good investment for the country as a whole. An educated workforce is a driver of growth and is crucial for sustained prosperity. And that is important for all of us. It is vital that we ensure people can access the education they want and they need, and that we find ways to ease the financial burden for everyone. It is a fundamental element of the United States economy, and we are better off for it. Thank you. Questions? Yes, Father.
I'm a beneficiary of the GI Bill of Rights.
Right.
I was in the Army in 1945 and 46, and for every 1 month in the military, we got 2 months of free higher education. Now, the GI Bill was called the Serviceman's Readjustment Act of 1944. It was passed because there was fear of massive unemployment when the GIs came back.
Right.
The bill paid your tuition, fees, and books up to $500 a year. Now, you could make it at St. Joe's, Georgetown, Villanova. Princeton was high price. It was $600. Now, what I would like to see is some thought given at the policy level to connecting civilian national service, Peace Corps, AmeriCorps, Jesuit Volunteer Corps, to an educational benefit. Now, the arithmetic is out of whack, and it would have to be scaled down. But what would you think of a revival of a GI Bill type of benefit? Because it was grant, not loan. And in our time, when there was a lot of drift and purposelessness among the young, getting them at the age 18 and 19 into a service opportunity, but rewarding them for that service with higher education benefits.
Well, thank you, Father. And so let me reiterate my disclaimer. I'm only speaking for myself, not for anyone else in the Fed. And second, I am not a policymaker on that side of the aisle, right, in terms of making policy with respect to fiscal policy broadly and education policy. So I don't want to necessarily tread on anyone's turf. That said, I think what we need are many and varied approaches to helping people access the education they need and want. One of those is exactly as you mentioned, having some benefit for people who have been in the Peace Corps or other, although in the Peace Corps, typically you already need a college degree to even get into the Peace Corps. So there may be other venues where we can offer that. And I think that's worthy of consideration. Second, I'll go back to the learn and earn kind of models, where you can be an apprentice and you can, I'll give you one example. So there's a fellow I met, we have a report we put out on apprenticeship programs. When you hear the word apprenticeship, you probably think, he's talking about construction or manufacturing. No, that's the old school stuff. Today, you're seeing apprenticeships in areas like financial services, healthcare, a lot in IT. And these are learn and earn programs. These are not unpaid internships. These are programs where as a student, you can learn and earn and work as you're working. So this fellow I met when we were releasing this report at the Philly shipyard, he's a welder. And he said, you know, through the apprenticeship program, I got 29 college credits at Delaware County College. I went on, got my associate's degree. They saw in me that I would be a good supervisor. They promoted me to supervisor. I'm now working on my bachelor's degree, and I'm going to move up in this company. So the point is, I think, not everybody needs to follow the same path that most of us followed. I can say I followed, right? Elementary school, high school, college, on, right? And so there are lots of other pathways. And I think this is one of them, Father, that you mentioned, which is giving some credit for that service that somebody did, say, in the gap year or years between high school and college. And there are other such programs that are possible. What I think, in a nation as diverse and varied as we are, we should have lots of different opportunities for people, right? We shouldn't have a one-size-fits-all, because that's not the country we are. And so I think there are a lot of these opportunities. Some of these are happening at the state level. I think there's some states that are quite innovative. Like when I was at Delaware, if you went to our program, which was an associate's program taught throughout the state, the first 2 years were free, completely free. And the community college was free. And then you transitioned to the University of Delaware seamlessly and got your degree. So there's lots of different pathways. And that's what we need to do, is just provide more and more opportunity. But in that, what we need to focus on is getting students to complete. I want to go back to what I said. The worst case scenario in our economy right now is people who attend college for 1 or 2 years, never get their degree, are saddled with that debt, and didn't get any of the economic benefit. And actually, where you see that most starkly, if you go back, say, 12 years ago, and look at the institutions, the academic institutions that issued the most debt, 12, 15 years ago, it was some of the Ivies and others. They've changed. Today, it's almost all for-profit institutions. And I think we have to bring into question whether that's a good thing. Thank you. What else? Yes, sir, in the back. We'll flip back and forth.
Hi, my name is Greg Dexter, senior finance and economics major here. Thank you for being here today. I was wondering what effect you believe increased access to student loans, especially from the government, that has on rising tuition costs.
Yeah, that's a really good question. So it may have some effect, there's no question, but the best book I can talk to on the question of why is tuition rising, why does college cost so much, you'll remember this. It's a book entitled Why Does College Cost So Much? And it's by 2 economists at William and Mary, Archibald and Feldman. And they go through all these likely suspects, right? What are the likely suspects for why college costs so much? The rock climbing wall is a sort of standard one, right? I don't know if you guys have a rock climbing wall, but that's raising tuition. Well, no. I mean, if you look at a university budget, I use Delaware as an example, 70% of the costs were people. The rock climbing wall is not driving the cost. So there may be incentives for institutions to have raised tuition, but often they then use that to subsidize other students through financial aid, right? So there's a cross-subsidy going on across campuses. So it may be that the access to federal loans cause some effect, but Archibald and Feldman and some other studies have shown if there's an effect, it's not the dominant effect. Right? I'm not saying it's not an effect, but it's not the dominant effect. The dominant effect, without a doubt, and why it's a broader issue about the economy, why productivity is so low, goes back to something economists call Baumol's cost disease. What is this? So Will Baumol was a very well-known economist at Princeton and at NYU. And Bill Bowen, who had been president, he's an economist who was president of Princeton for a while. Back in the late 1960s, they wrote an interesting paper. This is what academics do. We sit around thinking about, they asked the following question. How would you improve the productivity of a string quartet? Yeah, that's an odd question, but they wanted to make a point. So what would you do, right? So you have a string quartet. What would you do? Drop a few notes and see if anybody noticed? Speed up the playing? What would you do to increase this productivity of the string quartet? Their bottom line in this paper was they were using the string quartet as the extreme example of a service-based industry, right? A labor-intensive industry. And they said, basically, you can't do anything about it. So as the economy evolves, because services are low productivity relative to manufacturing and agriculture, you're going to see more and more employment in services, even though we're producing more of agriculture and more goods. look at agriculture as the extreme example. We have gone through revolution after revolution in agricultural technology. Well less than 5% of the American workforce is in any way, shape, or form involved in agriculture. And we produce the food that feeds the world. So it's just productivity that drove that. Their point was something like a string quartet, because it's so labor intensive, you're not going to be able to get the same productivity out of it. So today, we're bumping up to 70+% of our economy is services. And it's not going to change. That's just because we've seen this rapid increase in productivity in manufacturing and in agriculture, and we're not seeing the same in services. So the point was, back in the 60s, chill out. This is going to happen. There's not a lot you can do about it. But that has become increasingly unacceptable in the 2000s. Why? What we're talking about here is the cost of higher education that is fundamentally being driven by labor cost. You can say the same thing in healthcare. We can go down the list of all the major service industries. Where we need a productivity revolution is in the services to increase productivity overall and lower costs. So go back to the question of the string quartet. So what would you do? Well, today the answer is, and you're seeing this all across the country, where local symphonies, including the Philadelphia Orchestra, are going Chapter 11, going bankrupt. Why? Well, I could get dressed up in my tuxedo or my suit and go down to the Kimmel Center and hear the orchestra, or I can go into my person cave in my basement around with my 86-inch screen and my surround sound and turn on, the Met from New York, and I don't have to get out of my house. And so technology can help solve some of that problem. I think there's going to be a revolution in education around technology that's coming. You're already starting to see it. I mean, that doesn't mean that we'll supplant the traditional forms of education, but they'll be different. That's the only, what we know from economic history, the only way to improve productivity is some increased use of technology and lowering the labor cost. It's the only way. And so I think you're going to start to see that in industries like education, healthcare. But if you're interested in this question, it's a really good book. Why does college cost so much? Easy to remember. Yes, sir.
So you mentioned a few things. One way that we could tap into higher productivity growth would be to have a stronger emphasis on females being employed in the labor force. And you also mentioned that as an average, we're living longer and also healthier. While difficult as a policy objective, what's the feasibility of heightening the retirement age, kind of tap into productivity growth that way?
So heightening retirement age, just be a little technical here, would not increase productivity, because productivity says output per worker, right? So it's not the number of workers, but it would increase the labor force. And I think there are a variety of things we need to think about with respect to increasing labor force, because this increase in productivity that we need, particularly in services, is going to take some time. We are going through, and you're feeling it. I mean, your generation is going to feel it, a pretty significant shift in the economy with respect to technology. Everybody's worried about the robots coming. Elon Musk is warning, we're going to have the robot apocalypse and all that. I'm a little less worried about that than Elon, but it is an issue. But everybody's talking about them taking over the factory floor, right? I think manufacturing is 13% of the U.S. workforce, 13. So yeah, it matters for those people who are in the 13%. I'm not knocking that. But it's not going to drive the economy as a whole. What's going to drive the economy as a whole is services. So it's really the question of until we get a larger productivity increase, what are we going to do? Well, let's take the extreme example. Let's look at a country where they've got a real problem with labor. And I'm then going to argue we have a problem with labor in this country too. So take the extreme example, Japan. Japan has been in an economic malaise for now a long time, right? Decades long. So they're running out of workers. So they have been doing things like asking older workers to come back into the labor force. They're doing things like using robotics in unique ways. I mean, there's a couple companies in Japan who are experimenting with robotic home healthcare aids. Because here's a job that's really important as we age, the boomers. We want to age in place, and so we need healthcare aides. They can't find people in certain communities, so they're actually developing robots to be. Remember Rosie from the Jetsons, the old cartoon? Yeah, so they're developing Rosie, basically, to be the home healthcare aide because they're running out of people. Part of the reason Japan's in this malaise is the demographic trend has just flattened. They're actually decreasing in terms of population. So what do you do about that? I mean, I think there are a couple of things you can do about this. This is a really good question. So again, go back to economic growth. Economic growth is growth of productivity, which is low, but maybe it'll pick up if we can get the services going, and growth of the labor force. So again, I want to put the caveat out there. I am speaking as a Fed economist and not policy on the fiscal and other side. But these are the facts. So what do you do? One, you could raise the retirement age and have some people come back into the workforce. That's possible. However, I can tell you, I had a brother who was a union pipe fitter crawling around in pipes. Really hard to do when you're 70 years old, right? So there's a certain jobs that would be difficult to think about doing when you're 75 years old, crawling around a pipe in an oil refinery. So we'd have to think about that. There are some jobs that just doesn't work. If you're working as a clerk or something, that's a different story. Second, we can focus on, and this is a major issue for the country, prime age males and females. We are seeing historic lows of prime age males participation in the workforce. Prime age males are men who are 25 to 54, and they are not participating in the labor force like they once did. In fact, you look at us versus all other developed countries, we're very low. Why? There's a lot of sociological research on this. Some of it is the opioid epidemic. People get put on disability and they rarely come off disability. They come off a little bit, but they don't come back very often. In fact, there have been studies of what do these men do. I mean, there's a significant portion of the day where a significant number of these men are watching TV or playing video games 8 hours a day. And there's reasons for that. But we have men not participating like they once did. Same is true for female participation. It's dropped off, but I think for different reasons and not as sharply. So in some cases, it's the cost of childcare. It's not worth working, right? I mean, take the extreme example here, which is transit access to King of Prussia. If you're a low-income person living in the city of Philadelphia, there are lots of jobs in the King of Prussia area. But you have to take 2 or 3 buses to get there. And if you have children, and by the time you do that, and the cost of doing that, it's simply not worth having the job. Because you can't, both in terms of time and the financial cost. So and again, there's lots of emphasis right now, and there should be, on bringing those people back into the labor force, because we need them. I mean, we're hitting, at 4.1%, we are estimating probably the end of this year or next year, we'll go with unemployment below 4%. This is an area we have not seen in the U.S. economy for a long, long time, with very little pressure on inflation, by the way. So what do we do? So we can try to bring people back. That's a good thing. But there's no large group of people like the 70s where women entered the workforce in large numbers, right? So there's no large demographic group. But there are groups who are not participating in the economy like they should, or we want them to. I mean, historically, African-American males have had an unemployment rate at least double other groups or the national average. So again, we need those people to come into the workforce. We need programs and ways to get them in. But then there's the last one. And again, I want to reemphasize my caveat. One of the great strengths of the United States is immigration. And this is an area, and I'm not speaking in any other sense other than the economic sense. We need to think about a sensible immigration policy. Something like 70% of the companies that have gotten started that are worth $1 billion or more are immigrants. Just think of Intel. I mean, you can get company after company. A significant number of small businesses, startups, are immigrants. It's not just hiring workers, but it's also if you think about it, it makes sense, right? If I took the risk to come here and overcome a lot of odds to get in this country, then I'm a risk taker more generally, and often, as waves of other immigrants have found, like my immigrant Polish and Irish grandparents, Nobody wanted to hire me, so I had to start something. I had to survive, and so with that creativity, I create new industry, new opportunity. So we need a sensible immigration policy. I think it's all the above. The answer to our problem isn't any one of those things, it's all those things at the same time. And that's hard for us to do, but that is the answer. Yes. Yes, way in the back here.
I wanted to ask your opinion on the relevance of externalities and how we measure GDP and output. I know, the Fed has also thought about whether there are alternative measures or better measures or additional measures of
Yeah.
output. And especially with respect to environmental issues and climate change, it seems like people are beginning to volunteer to address these issues and are not necessarily getting paid. And I just wonder if that has an impact on some of these productivity measures. It seems to be a disconnect between public awareness
Yeah.
and, anyway.
No, I think it's a good question, which I'll put into a slightly different context, but it will address your issue. We do have uh, issues around measuring GDP and inflation and productivity and all of the above. And one of our economists, Leonard Nakamura at the Philly Fed, has done a lot of work in this area on this measurement because you think about it, a lot of the benefit, I mean, you're sitting there with your smartphone with a lot of apps that hopefully make your life more productive. None of that gets captured in the data. Now, the fact is, you don't have to go back very far before the smartphone really took off with Apple. We had a Garmin GPS. We had a music player. We had a Game Boy. We had this. We had that. All that got thrown away with one device in your pocket. But we actually don't know how to capture that advance in terms of the statistics. And that's Leonard's point. So most likely, if you believe what Leonard's saying, we're underestimating GDP. And as a result, we're also overestimating inflation. And we're underestimating productivity as a result. Because a lot of the productivity we see is not, we still have a model, and all of us do, and it's true with the economics profession. We still have a model that, the canonical economic model, right? There's capital, there's labor, you throw it in a production function, and out comes output, right? That's a model that really is a remnant of the industrial age. If you go back to services, one of the most distinguishing characteristics of a service, and this gets some of the environmental issues, is that services are distinguished more generally. We have an economy where it's co-production, right? If you expect your doctor to heal you and you eat too much and you drink too much and you smoke too much, and you go to the doctor and say, okay, you've got the capital, you've got the labor, heal me. And the doctor says, no, you got to put some skin in the game here. You got to put some work in here. You have to do some things. You say, no, I don't want to do that. I don't want, just heal me. That's not the model we have, right? You will not be healthy unless you take care of yourself. That's true of an individual. It's true of an ecosystem, right? And so on. So we're in a different model where there's, using a technical phrase, co-production. That is, the production isn't just on the firm side, it's the firm and the consumer together, produce whatever they're producing. And that's a characteristic of services generally, but it's definitely a characteristic of things like the environment, right? So the firms can do whatever they want, but unless we're willing to do our part, we're not going to move the needle. And that's true in healthcare, it's true in environmental issues, it's true, you name it, right? Social issues more generally. So I think that's the economy we have, and it's a different concept of what the economy is versus the old industrial model of throw some capital at it, throw some people at it, and out comes output. It just doesn't work that way in today's economy. Time for maybe one more question?
Right there, on your right.
Oh, right down here.
I just had a quick question about Thank you. Yeah, I just had a quick question about some thoughts more on student loans. If you look at the banking side of student loans, there's some similarities in characteristics between how the mortgage market evolved in the early 2000s. It's becoming really easy to access student loans. They're being packaged into ABS securities and being sold out. I think the market's grown to over $1 trillion. And, you even talked about it before. There are college students who take out huge amounts of loans and don't graduate, which is just another characteristic that could lead to higher default rates. Just out of curiosity, is there kind of any discussion about this that you're seeing on the policy side, and what kind of things they're saying about it?
Actually, a lot. First, the vast majority of the student loans in the country are government guaranteed student loans, right? So a lot of the companies you see are just servicers, right, of the government loan. I want to come back to that. But yeah, there are some concerns. I wouldn't say we're at the point of where we think it's a bubble or an issue, but it's something we're studying in quite great detail at the Philly Fed through our Consumer Finance Institute. So if you want, come on our website. There's a whole Consumer Finance Institute, and we've got a lot of research in this area. And there's more emerging all the time. We've got some more papers coming out in this area. But we are not just looking at the US model, but some models around the world. And one of the models that I think has some appeal, although we need to do some more research on it, is what some of the Commonwealth countries do, say New Zealand. So New Zealand, your student loan repayment, since the vast majority there too are government guaranteed student loans, because the banks are getting guaranteed by, or the institutions issuing it are guaranteed by the government, right, for repayment. So if there's any default, it's not on them, it's on the government. There's still private student loan market, but that's small in that $1.3 trillion market. But one of the appeals of the New Zealand model is your repayment is tied directly to your paycheck. So they've cut out the middle person. They've cut out the servicers. And that takes some costs out of the system. But moreover, when you graduate, you're going to fill out, remember those FAFSA forms you or your parents had to fill out? Well, there's going to be an equivalent kind of form you're going to have to fill out for the repayment of your student loan. And so what people are paying today in 2018 on their loan is based on the income they had in 2017. So if you lose your job right now, you're still on the hook for that because that's what you made last year. That's not true in the New Zealand model, for example. If your income goes up, you pay more. If your income goes, it's 10% of your income just goes off to pay your student loan. There's some appeal to that. Now, how it would translate to the U.S. market, we don't know yet, and that's some of the research we're doing. But I think there are other models around the world for how people do this that are worthy of some investigation. Because right now, it's a system that does need some rethinking. It's an issue that I wouldn't say it's a crisis. It's not a crisis like the Great Recession with the mortgage market. But since it is the second largest slice of the consumer debt pie right now, after mortgages, it is something that we as policymakers have to pay a lot of attention to. So with that, again, thank you for having me. Thanks.